If you can read charts, understand setups, you know how to trade. You're not a beginner anymore. You are almost consistent, but still can't make consistent money. You are not broken. You're just missing one thing that no one teaches. And I will prove it to you in the next few minutes. Watch this video till the end, and it will change the way you trade forever. I was analyzing the performance of one of my bots, and I remembered when I started in the market around 10 years ago when I left aviation, and I had a good insight that I want to share with you. What was the number one mistake that I regret the most? That took me years to discover and became my turning point: the quantitative and qualitative analysis over my strategies. Okay, but what does it mean? It means that if you follow these very few simple steps I'm gonna show you until the end of this video, you will find out that there is no strategy that works in every time frame, in every asset, and even the most successful ones do not survive the wrong amount of leverage. So you will learn now how to measure leverage, how to backtest the right way, how to survive sequences of losses, and when to increase the size of your positions. If you like more videos like this, please like and subscribe to this channel. As you can see, I'm just starting here on YouTube, so your like and subscription and even the comments here with questions will help this channel to grow. First, be careful with your FX broker. Do you know if you are A book or B book? Let's compare these two charts. They are both 15-minute charts. Can you see the difference? Check again. Look the size of these wicks. Look the size of these candles. Here, in these red circles, I try to match the size of the candles so you can see that the scale of the charts are the same. So why in one of these charts the amplitude of movements are much larger and the wigs are way larger? Well, one of these brokers is hunting stops, increasing spreads, making faster movements and larger wicks to make you think these fast movements will continue, so you buy, and these movements come back all the way on your face and stop you out. Why would they do that? Simple. When a broker B-book you, you are not trading against other market participants, like funds, other traders, companies, corporations hedging their operations. You are trading just against the broker itself. You buy from them and sell to them. So it means that when you make $100 in profit, they literally lost $100. Since most traders lose money, they end up winning. But to increase their edge, they make the market trickier, so beginners lose more money faster. A consistent trader is dangerous there. Some are blocked or invited to leave. Myself, I lost a few accounts because I use Algorithmic to trade, as you can see. Some brokers forbid high probability trades like arbitrage, pairs trading, or even the usage of bots and trading algorithms, which I will teach you here for free in the future, don't worry. If you don't believe me, let's ask ChatGPT. In 100 characters in trading, what's the difference between B-book and A-book? Which one is better? Is it true that some brokers hunt stops and increase spreads in B-book? For a consistent trader, is B-book or A-book better? A-book, brokers send trades to the real market. B-book, brokers takes the other side internally. A-books earns via commissions. B-books profits when traders lose. Some shady B-books widen spreads and hunt stops. For consistent profitable traders, A-book is safer and more transparent. But listen, I'm not saying that every single broker and prop firm that use B-book, they are shady and they are not honest, they are untrustable. That's not true. Some of them, they use a hybrid model where they put everybody, every beginner, every small account in a B-book and they mirror the market there, and once they see that the person is very profitable, they just switch automatically this person, the system switch this person to the A-book automatically, okay? The problem is when you trade with a small unknown broker or a small unknown prop firm, there is a huge chance of these people use the B-book to manipulate, to make the spreads really unpractical, larger than the size of a regular profit that you can have in a small time frame simulate higher volatility than it's actually happening in the market just to make you lose more money faster. Okay, that's the real problem we are talking about here. So these are some of the clauses they usually put on their client agreements. This allows the use of electronic device, software, algorithms, trading strategies. This other one, client agreement, forbid automated software, algorithms, trading signals, or trading strategies. Some market maker, dealing desk, they also put this, forbid arbitrage, hedging, scalping. Also some brokers in offshore jurisdictions, they are more likely to impose these bans because they want to protect their B-book profits and avoid exposure to systematic strategies. Okay? Many smaller brokers amber vague language, abusive trading, arbitrage is forbidden, hedging is not allowed in their policies. So what does that mean? It means that most likely, if you are very profitable because you use algorithms, because you have some long and short strategies that are systematic and winner over time, they will most likely accuse you of abusive trading and ban your account. Most likely you will not receive your money back, and if you try to complain, they will just block your emails and everything, and you have no way to get them because they are in some offshore jurisdiction. Okay, so yeah, of course I researched well and discovered a good broker with very tight spread that allows algorithmic trading, honest, and that actually everybody knows who they are. This one here, you can scan the QR code, and since I have a partnership with them, if you open your account using my link, you will gain for free my book, The Ultimate 100 Trading Strategies, a book with over 220 pages of strategies in detail. So all you need to do is to come here to this page, click on this link, and you can rather send me a WhatsApp or an email just with your full name and email and a screenshot showing that you will open your account at Tickmill. Okay, if you click here via this link, the second point is your trades are not measured by one trade result, 1 week, or maybe even 1 month of results. It's the combination of thousands of trades, thousands of results, hundreds and hundreds of days. Don't give too much attention to one result. Don't get too happy with one great trade. And don't get too sad with just one. Don't let the results of one trade destroy your track record. And don't let great results make you think you're invincible. I will prove it to you now. See this green line? This is the profitability curve of one of my strategies. Every dot is a trade. You can see lots of profitable trades in a row, and also many losing trades in a row. Look how slow and steady the profits are, but how steep the loss looks. Again, don't let one sequence of losses destroy your track record. What you're seeing now is just one bad week of trading. Now look at what 2 years looks like. See how small that steep loss sequence became? Got it? Just move on. Accept your losses, accept your wins, and move on to the next trade. Okay, but how? And that's the third point I want to talk about. Leverage. The wrong leverage makes you lose money. If you don't use enough, you lose money because you don't make enough money. If you use too much, you lose money fast and destroy your performance. Excess of leverage is typical of newbies. It shows you are not experienced yet. Anyone who truly knows trading also knows that consistency, slow and steady results is faster than try to make one big hit today and end up getting a big loss tomorrow. We only have 4 possible paths. Make a lot of money, lose a lot of money, make a little bit of money, and lose a little bit of money. If you remove lose a lot of money, it stays make a lot of money, make a little bit of money, and lose a little bit of money, because everybody loses. So if you remove lose a lot of money, you will be profitable over the years. If you avoid excess of leverage, you will avoid big losses. Big wins happens only once in a while, during crises or special days. That's not every day. That doesn't happen on a normal day. Every day we aim for slow, consistent results. If you are not over leveraged, you have peace of mind. You can have lunch, you can go to the toilet, You can go for a walk in the park with your wife and kids. You can go to sleep. You can go to supermarket with a position opened and not feel worried about it. Trading, it's not supposed to be exciting. If it feels like a game, stop all your positions right now. Deleverage as fast as you can and as much as you can. And the fourth point, even the best strategies do not work in every single asset, in every single time frame. Some of them work much better on the short side, some of them on the long side, some of them can work on both sides. That strategy I just showed you, look how it performs in another asset. Now imagine if I didn't know how to backtest in the right way. I would be trying to do the right strategy on the wrong place. Backtesting, it's not just looking at a chart, simulating what might have happened a few months ago in a random asset. So I'm gonna show you now the right way to backtest. If you don't know how to code, if you're not a programmer, ask ChatGPT to do it for you. Since this is not the scope of the video, I will not go very deep into it right now. But I will make a crash course for free here, showing the right way to backtest using code, even if you're not a programmer. You don't need to write even one line of code. Keep in mind that what I'm gonna show you right now is using specific backtesting tools and code, which I will teach you on the next videos, so subscribe to the channel to not miss it. And again, don't worry, you don't need to know how to code. I will teach you the lazy way. Backtesting, sample in, sample out, plus forward testing. Sample in, choose a few years and backtest your strategy. Shape it, optimize it as much as you can. Example, if it's a simple crossover between two moving averages, change one by one to see which pairs performs the best. Try adding exits like close under another moving average instead of just when it crosses back. Or I want to exit if it drops 2 ATRs or some specific price action stuff. Whatever, just find what works the best for you. Now sample out. Once you optimize it, don't touch it anymore. Now you backtest in another period. For example, if your sample in was 2021, 2022, and 2023, now your sample out will be 2024, 2025. To see if the strategy you develop will remain being profitable for the years ahead. If and only if your strategy remains resilient and performs well, take notes on which assets and time frames it works the best. After this backtesting phase comes the forward testing. Use a demo account for 2 to 4 weeks. If you use for 2 weeks, remember, always use the last week of each month and the first week of the next month, because these 2 weeks are the weeks with more volatility because the number of economic data that are released in these weeks. The goal of the forward testing is to see how your strategy will behave during news release, breaking news, consolidations, trends. This will also help you to fine-tune your position sizing. Once you finish that, you have two options. You can build a 3-month track record to gain confidence on the strategy and gather more experience and data with this strategy with high and low volatility periods. Or you can just run a small capital for 3 to 6 months before allocating more capital on it. Now, I guarantee that if you do exactly what I said here, you will become profitable over the years. In the next videos, I will teach you proper backtesting, strategy building, how to use AI to assist you in professional backtesting, how to get free backtesting tools, how to choose the right asset and the right time frame, how to measure leverage, and much more. So, subscribe, give a like, and ask anything you didn't understand so far in the comments. And scan this QR code to open your free account at Tickmill. They are one of the largest and most reputable brokers. Honest, transparent, and not some shady place. I trust them, I use them, and that's why I partner with them. It just don't make sense to pay up to 8 times more with higher spreads in other brokers. No strategy survives to high costs and latency. Doesn't matter how good and efficient your bots are, okay? I'll see you on the next video. I'll try post twice a week. Let's see if I can do it. I recommend you to come back here once in a while to see if there is a new video.